Okay, good morning, everyone. It's 10 o'clock here for our February 19th dialogues. Thank you all for joining us, and to those of you that are watching later on via the recording. We've got two presenters today. Matt Dearson has joined us, and also Jack Davis. They're going to cover, Matt's going to look at some of the cattle options and marketing things that are going on, and Jack's going to look at some of the deadlines coming up related to farm bill sign up and crop insurance for your risk management components there. So that they get their full amount of time, I'm not going to spend a lot of extra minutes here. So I will turn it over to Dr. Dearson, and he can lead us forward from here. Thank you, Matt.
All right, good morning. We'll take a few minutes and take a look at some things related to the cattle market. Got some inventory numbers and charts, and then I've also got just a quick look at the 5-year average basis levels just to use for planning purposes as we look ahead for the remainder of 2021. So we'll start sharing my screen here. Oops, wrong screen. Just a second. Try this again. All right. Heather, would you confirm you can see my presentation screen?
I am confirming that. Thanks.
Thank you very much. All right. So good morning from campus. Football and other fun stuff starts today here. Cattle markets. So end of January, there's a cattle inventory report, and that showed that across the U.S., cattle inventories were down ever so slightly. And this just big picture view here of where cattle numbers are located. So the biggest volume numbers down there in Texas with their weather problems here as of late. And you can see that just in general, I mean, cattle numbers, all cattle across all cattle concentrated in the plain states with a few out in California. So we say that just to kind of set the stage. The cattle inventory numbers were backed up with a smaller percent of the heifer mix on feed coming into 2021. There were some revisions in that cattle inventory levels going back to revisions for most of last year, 2019 and 2020. And the big takeaway there was that there was a very low calving rate reported over the last couple of years. So if that's calving problems, if that's reproduction problems, they're not sure, but that's one of the ratios, the calf crop relative to the number of cows that's been flagged by analysts, especially our colleagues at the Livestock Marketing Information Center, where these charts come from. So the other takeaway that I saw, big picture, looking at the cattle inventory was what happened to the change in inventory levels compared to a year ago. We can see here on this map that the Plains states running from North Dakota through Texas all saw an increase in inventory across all classes and types of cattle. So this could be more cattle grazing wheat pastures down in the southern plains, more cattle on feed in a state like Kansas, and then maybe a decrease in dairy cow numbers in a state like Minnesota or Pennsylvania. So it all averages out, but you could see a concentration in the inventory levels across the plain states. Also highlights, if we look geographically here, all the states to the west of the Dakotas and the plain states here have had growing drought problems, dry conditions, or ongoing dry conditions started last year. So that's heavily concentrated in the Southwest. And we're seeing some of that start to creep in as we look at at the border. That carried over into hay stocks as well. So South Dakota's feed stocks were down slightly. To the east of South Dakota, hay stocks tended to be up a little bit, but to the west of South Dakota, hay stocks tended to be down a little bit. So a tough winter or dry conditions going into spring is going to put added pressure on the supply situation west of the plains compared to east. So big picture, some things that I see going on. Sort of how do you take that and move into some of the pricing and things? We've got a smaller supply of feeder cattle outside of feedlots. So it's a combination of a higher number of cattle on feed at the beginning of the year, but then also a smaller calf crop. So that combines to give a slightly smaller number of cattle outside of feedlots, or cattle that could still be pulled into feedlots. So that's been supportive of price to have that level back. Not quite as low as when the expansion was happening here, but that's still just a modest level of feeder supplies to be drawn from as we look ahead to the rest of 2021. The other thing is the beef replacement heifers. So this too has just steadied or flattened out. So it's neither really a strong contraction or expansion type of indicator here, but just kind of showing that, probably got some heifers, especially if you look at the western half of the United States, that could still be pulled out of the replacement crowd or left in the replacement crowd, and you'd see some additional culling happening of older, more mature, heavier weight cows. So a couple things I observed if we look at the cattle inventory report. Focusing in on South Dakota, it's kind of a straightforward total inventory story. Usually you have inventories at the state level fluctuating kind of plus or minus 100,000 head. So a slight increase in the total inventory number here, but you can see it's not a huge cycle or anything happening relative to, say, the national level for inventory fluctuation. That kind of hides or disguises a couple of smaller trends that are in the inventory levels. The first of which is what's really been a fairly strong increase in dairy cow numbers. So I think go back to 2015 here in the middle of the chart, and you can see you've got, while the beef cow numbers have fluctuated slightly, you've got this steady increase, and especially last year, a sharp increase in the number of dairy cows in the state. So those numbers were solid at the beginning of 2021 here. So that does signal a pretty strong continued increase in milk production at the state level and related feed consumption. So those dairy cows are going to put a fair amount of feed consumption pressure on corn prices, soybean meal prices, and alfalfa and other forage prices as well. The other category that shows up a little bit, or we can see it in the January cattle inventory report, is again a slight increase or growth in cattle at smaller feedlots. So here we've got on the bottom, we've got the small feedlots and the large feedlots. Cattle on feed and large feedlots, those reported in the cattle on feed reports, that number is steady compared to a year ago, but the total cattle on feed was up slightly. So that's coming from feedlots with less than 1,000 head. So kind of wondered last year, it's like, what were the COVID implications in terms of individual operations hanging on to or feeding some cattle locally that they maybe would have shipped elsewhere or sent to a larger feedlot. So seeing that inventory up slightly meant that maybe some of those cattle just stayed put, were fed a little longer, and added to those small feedlot inventories. Moving on to prices, you can see here, this is an annual price chart. So on the bottom row here is cull cow prices out of Sioux Falls Regional Livestock. Then we've got fed steers or slaughter weight steers. This is choice 2 to 3 or choice 2 to 4 steers, again from Sioux Falls Regional Livestock, reported by the Ag Marketing Service. On top of that, we've got the feeder cattle prices. So this is AMS reported sale barns from across South Dakota, and the highest price level in terms of dollar per hundredweight tends to be associated with stockers or 500 to 600 pound steer calves. And this series is also from AMS reported sale barns across South Dakota. So we can see that all the price levels have been fairly unremarkable compared to its history right before this, when we had super high prices, but relatively stable. And we can see this very pronounced pattern right through here, the COVID-19 V, as everything was disrupted, slaughter was disrupted, retail outlets for different beef cuts was affected, and we saw the price impact of that. And then didn't get a super nice V shape where everything bounced back to normal. That's still has yet to happen. But you can see that we've got some general price patterns there. And some of this is, so I'll focus on this live cattle price here. So is there, or how strong is that seasonal pattern in prices? Let's focus on live cattle. You can see here the seasonal pattern of live cattle prices. This is an average of those prices, 10-year average, standardized to get a price index at the monthly level. So this would say that if you had a price for the year, the price would tend to be 105% higher than that average price when you look at the month of March, and only 95% of that annual average during the month of September. So you do have a strong seasonal pattern that remains in live cattle prices. That pattern is what's responsible for, or behind the scenes, it's what's responsible for the basis levels that we'd use. So looking ahead or thinking about planning for the remainder of 2021, what kind of basis levels would one expect to see? This is the 5-year average basis. So basis is cash minus the futures price. So this is the average of the last 5 years of the cash price for a given month minus the futures price, the nearby futures price. So the month of March, for example, doesn't have a futures contract. So that's saying what's the cash price in March relative to the futures price for the April contract. So that strong seasonal pattern in the cash price carries over into a strong seasonal pattern in the basis levels. So basis levels for South Dakota fed cattle or finished steers, you expect to see $4 or $5 a hundredweight from March, April, June, and July. A much stronger basis level would be expected in May, because you'd have a strong May cash price relative to a lower June futures prices is what this is picking up. And you can see in the latter half of the year here, $3, $4, $5 under, or a cash price to be expected to be less than the futures price by a noticeable or sizable amount during those months. So that's what I would look for a basis level. And I like the 5-year average basis, especially for fed cattle. It seems to hold fairly well, smooths out the aberrations of a given year. And this is the cash price reflected here is both choice 2 to 3 and choice 2 to 4 steers. Feeder cattle, a similar type of pattern, feeder cattle, a similar type of pattern. We have the basis here would be a cash price for feeder weight steers. So 7 to, let's get that precise here. The feeder weights, the most recent prices would be 7 to 899 pounds. So the very earliest year of this 5-year average included some 7 to 8 weights, but now it's 7 to 900 pounds the last several years. So cash price for 7 to 900 pound steers in South Dakota relative to the feeder cattle futures price. So not every month has a feeder cattle contract, but you get the general idea. The basis in South Dakota on feeders tends to be fairly positive. So if I just had to state a price or a basis level, $5 over the futures price. So we've got 145, 150 futures prices right now. So I think that speaks to 150 to 155 cash price for feeder weights for South Dakota. Very little seasonal variability, a little pressure or a little bit of pressure on the basis at the very beginning of calendar year. Last basis pattern to just kind of share is the basis on stockers or 500 to 600 pound steer calves. Here too, you get a little bit of a seasonal pattern, and I'm a little more hesitant to just blanket use this 5-year average. What's happened in the last year, you've had substantial fluctuations, variability in the feeder cattle prices that this would be compared to, but you've also had huge fluctuations in the prices of corn and hay, both of which are corn and other feedstuffs, both of which are going to greatly affect the value of calves. So you want to take this with a little bit of a grain of salt. But you do see that seasonal pattern tends to be $30 to $40 early part of the year, and then when we get the bigger runs of cattle in the late fall, early winter, you have that basis tends to be closer to 20. But again, you kind of want to just use that as a general guide, and then I'd find a year where you had similar feeder cattle and corn and hay values to really make some pricing decisions relative to that. The last comment on the cattle prices, actually, I'll just circle back to that. We'll show one more chart here first. Jack's going to talk about crop insurance a little bit, and I wanted to just highlight that if we look at pasture and range for South Dakota, one insurance product that is available is pasture rangeland forage insurance. The deadline to purchase that for this year would have been back in November of 2020. So this insurance product is the insurance decision to insure pastures already been made using the PRF product. But for 2021, we saw across the state about 3.5 million acres of PRF insurance coverage was purchased. That takes the insurance level up sharply from 2020 and back closer to the highest level seen in 2018 and 2019. So producers saw drier conditions and did some management decisions to buy the insurance ahead of time. And then aside from this, so 4 million or 3.5, 4 million acres looks pretty good, but there's 22 million acres of permanent rangeland and pasture in South Dakota. And there's another few million acres of temporary pasture or cropland that's grazed and hayland as well. So this is not a super high percentage of the overall forage crop. But it is one thing or one positive sign that some producers were taking proactive steps ahead of this. Now, you can also still buy NAP coverage. That deadline comes up on March 15th. That would be another way to cover pasture and rangeland. So those were the prepared comments I had. I've got a couple of additional thoughts, and then I'd take a couple of questions. Let me stop sharing quick. A couple other things I've noted right now. If we look at the price levels, we've had good price rallies despite the higher crop prices. Good price rallies pretty much the last couple of months here. And we look at the second half of 2021, might be a time where you'd see some opportunities, especially on the live cattle side of things. If the economy can start crawling out of the COVID doldrums, what's that going to do to meat demand, beef demand in particular, maybe do some things to the higher end cuts, prime prices and such. So that's a possibility. And then the other thing that's happened with in those markets, the implied volatility is fairly low on both live cattle and feeder cattle, especially for the deferred months. So I think that's a good sign. Price levels are good or okay to good, and then you've got low volatility. So if you're looking to do some risk management for that second half of the year, maybe even on this calf crop that's starting to hit the ground these days, that might be something to look at. Or on the fed cattle side, some price protection might be more affordable the further out you look. So just some observations. And if there's quick questions, Heather, you're kind of, it's your show. When do you take questions?
Anybody has questions, please let Matt know or type them into the chat box and we will get them to him. So I don't have any that have came in.
Okay. That's fine. And if you do have some cattle questions, observations, please do feel free to contact me. I'll be hanging out for a few more minutes and then I have to run off to class.
I got one, Matt, of course. Sure. Have you guys talked on that? Wasn't there some changes to the LRP? Like it's more subsidized? Maybe you guys have talked about that in another dialogue already.
Yeah, we have addressed that several times in the dialogues and through some, mainly some releases that have come out tied to the LMIC. But the higher subsidy level is making that product more attractive than it would be otherwise. So a much higher subsidy rate on the insurance premium just makes it more affordable. So for a while, it was an increased subsidy was offsetting a much higher volatility level in the cattle. The volatility's come down, so that LRP coverage is going to be even more affordable going forward. So that'll be something really to take a hard look at for the calves, especially probably once we get into like April and May is when you'd really want to be taking a look at that too.
Okay, thanks.
Any other questions? Oops, sorry, Matt. Didn't mean to cut you off.
I stopped sharing so Jack could start anytime too. So.
Okay, so if you do have questions, type them into the chat there for Matt, and we will make sure we get those answered for you. Otherwise, Jack, let's turn it over to you and shift gears a little bit and look at some of that risk management side of the crop side.
Well, get all my buttons in line here. Did my screen, are you guys seeing my screen?
We are, but I don't think we're on the first page.
No, it's not back to the first page. Okay, I'm going to stop it and start over. Hang on. Oh, did I just, am I still there?
Yeah, you're still here.
Okay, it looked like I left. Sorry. Boy, I'm fumbling today. All right, back to here. Share screen. Now we're on the starting slide.
Yeah, so if you now go to slideshow.
There we go.
Start from, there you go.
Wow. Some days. It's not the 13th, is it? All right. Well, I'm Jack Davis, Crops Business Management Field Specialist out of the Mitchell office. And here's my contact information. Email probably kind of the quickest. And once we got that, you can get my cell phone too. So, and if you leave me a message at the office, that comes through to my email too. So any of those ways will work. So we're going to talk, we got some deadlines coming up. All of them really March 15th for program sign up. As Matt mentioned, the NAP coverage, if people are interested in that, needs to be purchased before March 15th, or that's the closing date. So you'd want to get to your FSA before that if you're interested in that coverage. And crop insurance then. The sales closing date for crop insurance is March 15th. So we'll do a little on the farm program sign up and then show where our crop insurance prices are as of this week. We'll show where those are at, and then we'll take a look at the USDA Ag Outlook forum is going on now in Washington, D.C., and we'll take a look at where they're projecting for acreages to be for 21. So here's our Farm Bill options. As I said, the deadline is March 15th. We're signing up for this crop that we're going to plant. And then the payment will be made in fall of 22 after the marketing year average is determined. So that's what we're looking at for our sign up. The last time we signed up for 2 years. So this will be something new that people have to do again. And you can choose, you can change. Unlike the last Farm Bill, where we were stuck for the 5 years, for the remainder of this one, we'll be choosing each year on which program we want to sign up on. And our choice is between ag risk coverage on the county level or the price loss coverage for each FSA farm number and its crop base acres. The other choice, which some chose at the start of this, is ag risk coverage on the individual coverage level. And that, if you choose that, then you're out of PLC. It goes on all your base acres, but it only pays on 65% of base acres. So probably not as attractive choice at this time as it was for many in the first go around because of our large prevent plant things that had taken place throughout South Dakota. But if you had that and were happy with it, I'd still take a look at it. But for most, it'll probably fall into that ag risk coverage on the county level or the price loss coverage. So just a very short description, what I'll call ARC County, which is ag risk coverage at the county level. It's revenue based. So it takes yield and price into account and on the county level. So it really works like your RP, revenue protection insurance, crop insurance, except it's on a county level versus your individual farm. And that's the way that works. So if our county yield falls below the benchmark revenue, then a payment is triggered and people will receive a payment. It's also capped then. So there's a lot of math that goes into it. We have a calculator that will look at a couple examples and see where it might fall out. The other one is our price loss coverage, which is price support or PLC. So it's a price support safety net. And if the market year average price falls below what's called the effective price for that base crop, then producers will receive a payment based on their individual PLC yield and that price difference between the effective price and the actual market price. So here I've listed the effective prices for 3 of the major commodities, corn at $3.70, soybeans at $8.40, and wheat at $5.50. So just as a general summary for right now, it doesn't appear that there would be that the market year average price would fall below this effective price, but people need to decide again if they want that revenue protection or just a price protection. So it probably in general lean towards PLC for maybe corn and wheat. The PLC on our effective price on soybeans is so low that the ARC County is probably more attractive, because more than likely our soybean price for this upcoming marketing year won't fall below that 840. So now I think we'll take a look. I used a calculator that's out of University of Illinois or Farm Doc and some of their fast tools. And I just plugged information in it. I wanted to change this a little this week, and the day that I went to do it, it was locked up, so it wouldn't let me change. I could change the state, but I couldn't get the county. So I had done it a week or so before, and I had picked Brookings County. These are information that you can throw into this calculator. And I've got an example of corn, non-irrigated. I just plugged this yield in. Each individual farms may be different. We're going to look at the year coming up. So I'm saying you're doing pretty good, or you're going to hit an average yield in Brookings County this year, and the market year average price is staying at $4. So in that case, we would not have no price support or program coverage would kick in. So we're above the guarantee on our county level for ARC, and we're not below the 370 effective price for PLC. So neither payment would kick in. So using this same one, and I take the market year average price down to 356, which was a few years ago where we ended up and our price loss coverage had kicked in. So if that would happen and still end up with a strong yield, we would end up with $19 of price loss coverage subsidy or payment, I should say. And on the ag risk coverage on the county level, our revenue given these is protected down to 667. So if our corn would actually stay at $4 to get an ag risk coverage payment or to earn it, the yield would have to drop to less than 167. So it'd have to have a fifth, almost a 40 to 50 bushel yield loss before that ag risk coverage would kick in, given a $4 price. And I think I have another example here. So this one taking almost a 30 bushel yield reduction, or ending up at 181, and also then of the lower price, shows where they're about even. Let me get to my pointer to show. So the PLC would earn or trigger the $19 payment, and the ag risk coverage at the county level would trigger a $20 payment. So I just picked that 356 because that was a market year average price in recent years when the price loss coverage was earned or kicked in. So that's what I picked just to show as an example, and where our yield would fall and make that ag risk coverage about equal to that. So this is a calculator that can be downloaded and used to play and help make the decision. Here I went down both the yield hit, large yield hit, and low price. So probably a worst case scenario happening, where in what it emphasized just in this example is that the ag risk coverage giving you that revenue protection, not only for a drop in price, but also for yield loss. So really a person just try, and I only pick corn. You can, if you choose the ag risk coverage on the county level, you could choose that by county, by crop, and by farm. So by your FSA farm numbers. So you can mix and match. if some people have more than one FSA farm number, it's not too bad of an idea on those that are close, like the corn, maybe you split it. If the farms have equal number of base acres in corn, maybe you put one in PLC and one in the ag risk coverage. So just a way of diversifying the risk protection. Coming up, we have our sales closing date for crop insurance. Probably many of the crop insurance firms will be holding their information days and appreciation days coming up towards the end of February, beginning of March. A couple things. There's an enhanced coverage option, which provides coverage up to 95%, and it's eligible to use with the ag risk coverage on the county level or the price loss coverage. And the other is supplemental coverage option, and it provides coverage up to 86%, and you can use that along with the price loss coverage. So kind of making your farm program choice look like, if you chose PLC, making it look like an ag risk coverage product or program. For the most part, in South Dakota, our yields are too much at risk, and these programs don't necessarily, they cost too much for what their benefit provides. Many just choose a revenue protection program for their crop insurance, and then take the yield adjustments and the trend adjustments and add those products on. Many use enterprise, which throws all the crop together, not just by section, and that lowers crop insurance and still provides pretty good protection for the farm. And combine that then with a hail product. So those are some pretty good ways to protect that production risk. I did go through and pull where our prices are, and just off to the side to have a little example of 150 APH, and I chose 70% coverage level. Much of the coverage in South Dakota falls in that 70 to 75% coverage level for corn and soybeans. So this was as of earlier this week, March 15th. Oh, no, that's the closing date, sorry. I don't know if it says what day I pulled this, just a couple days ago. So our projected price, better than we have been. We were at $4 most recently, so a little bit better there. And at the 70% level, you'd have $475 per acre of coverage. Here's looking at soybeans, got an example off to the side, and maybe many APH is greater than that, but I kind of picked probably a state average or a little more than state average even as we get further west. So about $368 of coverage using this example. And again, we got half the month or so to go since these were taken. And then I did spring wheat also. So just some examples of where that price, the coverage would fall in given these prices if they would carry forward throughout the month of February. Switching up just a little bit, taking the USDA Ag Outlook, their long-term outlook, and projected prices, and then here is acreage just in a chart with these crops being planted. So anticipating probably getting back up to levels that we were in 14, 15, this reflecting our large prevent plant year of 2019, and yet some of it in 2020. So total predicting corn at 92 million and soybeans at 90. So I pulled these this morning from that program, and again, getting acreages back up there to what they were back in 2017. And then looking at corn acreage, and of course using a almost like a trend yield. So total production of 15.15 billion bushel. Beginning stocks, will change throughout this year, but right now, right at 1.5. They went up a couple hundred million in feed use and residual use. Ethanol expecting somewhat of a rebound and bumping back up, not to its high, but above what is currently projected. So total use is up, exports up a little bit. So still, even with a more acreage and a good crop, where we end up with about 1.5, or right close to where we are today, a little bit above it for our ending stocks prediction for 21-22 crop. Same stocks to use percentage in about the same seasonal average farm price. So I think really, as we're thinking of your marketing going through this year, a lot is, as usual, when we get to tighter ending stocks to use, it's going to be all weather dependent, and we don't know how that will shake out, and how many acres will get planted, and then the stress as the crop grows. Taking a look at soybeans, expecting that to be at 90. Using the kind of the trend yield at almost 51 bushel gives us a pretty good production year, but we're coming in with such a low ending stocks to start that our total supply will be below what it is currently. Not much change that they put in their prediction for crush and seed use and residual use. Exports lowered a little bit, and coming in just a little above for ending stocks. So to me, in reading this, really soybeans need those acres to hold at this price. And if we get growing problems throughout the year, soybeans will go up, or they will, some of these uses will have to be cut. We'll get to at some point a point where rationing of the crop and its use will be sorted out. That's what I have for today. Questions?
So, anyone have any questions for Jack regarding all those numbers and the information that he posted for you? You will be getting the link for the recording after it goes through all the appropriate approval channels and those types of things. So if you want to look back at some of the numbers and the charts and the slides, that will be available to you that way as well. Well, Jack, I don't see any questions coming in at this point.
Did you type something in there, or something came in on chat?
Yeah, it was a thanks.
Okay, that's good.
So without any further ado, I guess, Matt has left for his class, so he's not available for questions at this point, but if you have them as they come up, please feel free to send them our way and I can get them to him if you didn't catch his contact info in his slides. So.
Yeah, and if there's other things you guys want to talk about or want us to address, let us know. You know, we can get it on. Might not be right that month, but we can sure get to it and see what we can do for you.
Right. We're starting to put together the March program. So if there's topics that you see that will be the hot topics or things that are coming up to address for March, it makes it much more informative for you if you have some of that feedback in there. So let us know what you think, and we'd be happy to work on some of the topics that you have for ideas other than just the 3 or 4 or 5 of us getting our heads together and trying to come up with an idea. So I guess with that, we will say thanks for joining us today and let you get on with your rest of your daily activities. So thank you for joining us.
Yeah, enjoy that warm weather that's coming. Wow.
Right. Be a heat wave coming here.
Yep.